Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello, Ben Rains here with Zacks top stock picks of the week. Today, I'm diving into Nike, which trades under the ticker NKE. Nike has been at the forefront of athletic wear for decades, and its cultural influence has never been bigger on and off the court, despite the rise of Lululemon and the resurgence of Adidas in North America. The company has been transitioning to a higher margin direct to consumer model for years, which includes various dedicated shopping apps and a massive reach across sites like Instagram where people can now shop directly. Nike has also digitalized its supply chain and it's investing in its own stores, what they consider in high value cities. And the company hasn't forsaken wholesale. Instead, it's beefed up strategic partnerships with the likes of Foot Locker and key players in the booming online sneaker market. Nike is coming off 2 quarters that highlighted its e-commerce strength, with digital sales up 75% in Q4 of FY 2020 and 82% in Q1, which are reported on September 22nd. The firm is projected to return to top-line growth this quarter after being hurt by the coronavirus in the last 2 periods, with bigger gains expected in Q3. Overall, its adjusted FY 2021 earnings are projected to soar 77% on 13% stronger revenue, with its FY 2022 earnings expected to come in another 30% higher on 11% stronger sales. This would mark a strong return to growth after FY 20's sales dipped about 4.4%. In fact, both revenue estimates for this year and next would represent Nike's strongest top line growth since fiscal 2012. Nike's strong post earnings release positivity on the bottom line has helped it land a Zacks ranked number one strong buy at the moment. Nike is also part of an industry that rests in the top 10% of over 250 Zacks industries. In 19 of the 25 brokerage recommendations the Zacks have for Nike come in at a strong buy. Nike stock is up nearly 30% in the last 3 months to rest right near its new highs at about $130 per share. Nike has also climbed about 130% in the last 3 years, and its 0.75% dividend yield roughly matches the 10-year US Treasury. Nike remains one of the most valuable brands in the world, alongside the likes of Coke, McDonald's, Disney, Apple, and others. Therefore, it appears worth considering heading into the holiday shopping season and for years to come. And now I'm going to turn it over to Dave Boren.
Hey, thanks, Ben. For my top stock pick today, I'm going with another iconic American company, Winnebago Industries. For a long time, the name Winnebago has actually been synonymous with recreational vehicles. You wouldn't say I'm going in my RV, you might just as well say I'm going in the Winnebago. At the beginning of this year, it looked as though industries like this were in trouble. With the pandemic, with serious economic uncertainty, it was unlikely that people were going to make big discretionary purchases like a new RV. That thinking turned out to be totally wrong. So people actually liked RVs, went running for RVs because it meant that they could travel without going on an airplane. They could stay without staying in a hotel. They could bring with them only the people that they wanted with them. It was a great way for them to get out anywhere in the country without getting into those risky situations. So Winnebago shares bottomed out at almost $20 at the lows in March. But then as people realized that RV sales were not only going to be okay, but actually were about to take off, those shares raced all the way up to $71 in June. Last week, Winnebago reported their fourth fiscal quarter earnings, and it was a blowout. $1.45 a share in net earnings versus expectations of just 90 cents. Now for next year, revenues are expected to be $3 billion. That's a 25% increase over this year. And that, I want to be clear, that's next year that starts right now. Winnebago operates on a fiscal year that's offset to minimize the seasonal disparities in sales. All right, so we just finished the fourth quarter and we're going into the first, and next year looks 25% better sales-wise than this year. We're also looking for earnings of $4.47 a share next year. That's a 75% increase over the year they just finished. Management on the call was unabashedly optimistic about the RV market. But we've seen a little bit of a slide lately in the stock, and those shares continue to slide even after that great earnings report to about $49 a share recently. So while they may have been a little frothy at 71, at 49, they're starting to look great. That represents a 12-month forward PE of just 11 times. So that's low for the industry, and it's less than half the forward PE of the S&P 500. Now, I believe the reason for this slide is that investors are really looking for guidance. And while the Winnebago management on the call was, again, very optimistic about the year they just had and the year going forward, they failed to provide any specific financial guidance, which is a warm blanket for investors they've been looking for, and they just didn't get it. I think this represents a considerable buying opportunity. One of the pieces of guidance that they did give was that they have almost a $2 billion order backlog heading way into next year, and 750 million of that, almost over a third of that, is in towables. So these are less expensive recreational vehicles that go behind another vehicle. And it shows that Winnebago has penetration in all areas of the market, from the most inexpensive RVs to the most expensive. Now, I think RVs are going to hold up in general. Camping World Holdings, that one of the nation's largest sellers of RVs, also doing great. And the reason is, although that there is a record high unemployment and some other stubborn economic factors, the people that buy RVs are by and large in fine economic shape. So I don't see this trend abating anytime soon. That's what makes Winnebago Industries my top stock pick.